If you've ever wondered what a typical discussion is like amongst the analysts from our IFAST regional research team when exploring and analyzing investment ideas, this segment will give you a picture. Today, they will each pitch and defend their investment cases for various sectors in China: technology, healthcare, financials, and real estate. In the arena today, from our research and portfolio management team at IFAST Singapore, we have Ian, Heather, Huishi, Ferlin, and Weiren. Let's give it up for the presenters of our China debate session.
Good afternoon, everyone. My name is Weiren, and I will be the moderator for this session. And as Gladys has already mentioned, this session is actually called the China debate. And as the name suggests, this segment specifically zooms into the Chinese equity market. And very specifically, what we will be doing is we are going to explore the various sectors in China at this point. And I have with me today 4 analysts, and each one of them will be representing a different sector in China. And just to recap their names one more time, over to my furthest on my right, furthest to my right is Ms. Heather Lim, who will be representing China Tech, followed by Huishi, who will be representing the real estate sector, and also Ms. Ferlin Tan, who will be representing the financial sector. And I also have with me on the line Mr. Ian Lee. He is based all the way in Shanghai, and he will be representing the China healthcare sector. And as we all know, Shanghai right now is under lockdowns because of the COVID-19 outbreaks. So Ian, thank you so much for joining us today for this session despite all the lockdowns. So just to kickstart today's discussion, I thought it would be interesting to get Ian to share with all of us his personal experience so far in Shanghai right now. So Ian, first question to you is, how has your personal experience been in the lockdowns in Shanghai? And could you just share with members of the audience, what have you been observing during the lockdowns, and what is your personal assessment of the situation on the ground?
Hello, Weiren. Hello, everyone. Thanks for inviting me. Shanghai started lockdown around the middle of March. I thought it would last no more than a month at first, but the restrictions is taking Shanghai's lockdown into its 9th week. At the very beginning of lockdown, some residents, especially elders, foreigners, who are not familiar with community group buying, have been struggling to access food supplies and forced to wait for government drop-offs of vegetables, meat, and eggs. Also, people are not allowed to go outdoors unless taking nucleic acid test. But the test will make people feel strained because of potential infection risk. Over the past few weeks, personally, I'm getting used to working remotely, and I've been doing a couple of things to help deal with the ongoing pandemic and the restrictions. Clearly, Shanghai lockdown is costly for economy because it's a hub for semiconductor, electronics, and car manufacturing. I believe authorities will ease restrictions to restart the city's economy soon, as we still have to meet 5.5% economic growth target this year. I don't think other major cities like Beijing will repeat the mistakes after a much criticized month-long lockdown in Shanghai.
Well, Ian, over in Singapore, we have actually heard a lot of things about the lockdowns in Shanghai, from the food shortages that you have just mentioned, and we have also heard about some of the extreme measures that the government has been taking to ensure zero transmission of COVID-19 cases. So could you also give us a bit of color and also a bit of background as to what are some of these measures that a person could be experiencing at this point during lockdowns? So what happens if you or any of your neighbors in the building test positive for COVID-19? What actually happens?
it would be a terrible case. In fact, during this time, we should self-test every other day and report any positive results. And the nucleic acid test has been conducted citywide almost 10 times so far. The infected patients and close contacts will be transferred to government-run centralized quarantine to up to 2 weeks, no matter the circumstances. Even newborn juveniles who tested positive will be separated from their parents and transferred to quarantine by themselves. Also, it's not uncommon for hundreds of people to be put together in such centers. Images shared on social media have showed unsanitary conditions where patients are unable to sleep properly and receive proper treatment, but they are not allowed to leave until tested negative.
Looks like the situation there, it's still pretty uncertain. And also one of the reasons why we have arranged for Ian to begin his sharing first is also because he can be called on short notice by the Chinese government to do an emergency PCR test. So such is the uncertainty and fluidity of the situation over in Shanghai right now. So Yan, today you represent the healthcare sector, but as we all know, the strict enforcement of COVID-0 measures, this has actually placed a severe strain on healthcare resources in China. But yet, Yan, you see investment opportunities within China's healthcare sector. So right now, I'd just like to invite Yin to present his investment case on why investors should still consider an investment in China's healthcare sector amidst this uncertainty. So over to you, Yin.
Thank you. Good morning, everyone. This is Ian from CN Research, and my topic for today is short-term correction in China's healthcare stocks, an attractive buying opportunity for investors. In year 2021, China's healthcare sector recorded a minus 16.6%, underperforming the CSI 300 index by roughly 11%. And the sector has continued its downturn trend in 2022. The healthcare index has dropped down by circa 24% by the end of April. We believe that there are two main reasons resulting in the correction. Firstly, valuation bubble. The healthcare sector increased by over 100% during 2019 and 2020, which hit two standard deviation above 10-year PE multiple. Secondly, China's centralized drug procurement policy has weighted on sentiment towards healthcare companies, which had to deal with drug price cuts. In recent years, China's centralized drug procurement has been the main policy that has guided the reform in the industry. The key focus of this policy was on price reduction and fee control, and was initiated to improve the affordability and the availability of drugs in China. At this point, after a few months correction, we believe there's a buying opportunity. We are confident that leading healthcare companies in China will be able to adapt quickly to the new normal of centralized drug procurement. The growth drivers underpinning China's healthcare sector include China's aging population, potential increase in medical expenses, cost advantage enhances international competitiveness, and Internet plus health industry, a new landscape for the sector. To clarify, China's population is rapidly aging. Its fast-growing society means that there's an ever-growing need for healthcare services. Next slide, please. Especially when considering a recent spike in demand resulting from COVID-19. According to the population census in 2020, the population of people aged 65 and above account for around 13.5% of the total population. Meanwhile, the growth rate of newborns in China has been negative for 3 consecutive years. While China has recently introduced a new three-child policy aiming to alleviate the problem of aging population, we believe that this policy is unlikely to be a quick fix for its demographic challenges, as the high cost of raising a child in China. Next slide, please. Second of all, as can be seen from the left-hand chart, the overall healthcare expenditure has maintained a steady growth over the past years in China. Additionally, as the largest player in pharmaceutical industry, the national medical insurance shoulders a considerable portion of medical and health expenses. According to the data provided by a National Medical Insurance Bureau, the total medical healthcare expenditure in China has increased from 2 trillion yuan in 2010 to 7.2 trillion yuan in 2020, representing a compounded annual growth rate of about 13%. Despite the strong growth, we believe that the expenditures has further room to climb as the industry is relatively nascent compared with developed countries. At present, China's healthcare expenditure totaled 7.2% of total GDP. This is still lower than the world's average of about 10%, and much lower than that in the developed countries in European and US. Besides, the competitiveness and the market share of companies in China's healthcare sector are constantly improving compared to their international counterparts. Next slide, please. Over the years, local pharmaceutical companies have been trying to catch up with multinational pharmaceutical companies in innovative drugs and research and development, and they have made great progress. The number of domestic new drug applications and the registrations has also reached a record high. According to the National Medical Products Administration, a total of around 2,000 new drug applications were accepted in 2021, which is higher than that in 2020. Besides, China's contract research organization and the contract manufacturing organizations have leveraged on their cost advantage and China's talent pool to continue obtaining international orders and expanding their production capacity. Next slide, please. Last but not least, Internet Plus health industry develops rapidly in recent years, and investors shouldn't miss out investing in this area. As we all know, since the pandemic, policies have been introduced to promote online sales of prescription drugs and realized medical insurance payouts to internet hospitals. This is a major move to open up the internet hospital ecosystem and form a complete closed online loop from consultation and prescription to settlement and medicine delivery. As you can see from the table, I summarized the major Internet Plus conglomerates, and it's clear that major players all extended their footprints to build a comprehensive service portfolio. Next slide, please. Although the new policy, i.e. measures for supervision and administration of online drug sale in 2021 is stricter comparing with the prior version, which are likely to expand the restriction list of prescription drugs for online sale. We believe the prudent policy is essential to build a healthy and sustainable foundation in the long run. In the next 10 years, we foresee the healthcare industry will undergo an unprecedented transformation with the application of high techs such as big data analysis, AI, 5G, etc. which helps form an efficient and safe information sharing mechanism. We still believe that healthcare products uh, uh, like e-commerce GMV should grow around 18% CAGR over 2020 to 2023 to reach like 1.1 trillion yuan, driven by pharmaceutical products and a broad online penetration expansion during the period. And next slide, please. The valuation at the moment looks appealing, as shown from the left-hand chart. If you look at the subsectors of the healthcare, most current PE of which are at lower quartile. Also for the CSI 300 pharmaceutical index, on the right-hand side, the PE multiple falls below 10 years valuation average after nearly 2 years downwards adjustment. Next slide, please. So based on above, we are bullish on China's healthcare sectors this year. Investors can gain exposure to the opportunities within China's healthcare sector via Green Shares MSCI All China, which is a US-listed ETF designed to track the MSCI China All Shares Healthcare Index. We revised our 2023 target price for the ETF to $30, and this is based on a fair PE multiple of 30 times. And this translates to a potential upside of close to 24% based on the last closing price on April 2022. And this is the end of my presentation. Thanks for listening.
Well, thank you so much, Ian, for giving us a summary of your investment case for China's healthcare sector. But many of the points that you have highlighted inside your presentation are actually long-term drivers for the industry. And in the short term, there are obvious challenges. And as indicated by one of the charts you have just shared, there has been a sharp correction in share prices of Chinese healthcare companies. And over the past year, we have been talking about regulations and crackdowns. Tech, real estate, these have been the primary sectors that have been cracked down by China. But healthcare has also had its fair share of reforms over the past few years because the Chinese government actually wants to keep healthcare affordable to the general public. So what this has resulted in is actually a sharp price cut in drug prices. And we're not talking about just 20-30% decrease in prices. We're talking about 70 to 80% decrease in drug prices. And this is going to affect the profitability of Chinese healthcare companies. So my question to you, Ian, is are you not worried by some of these healthcare reforms that are taking place in China right now?
The impact of this reform on different enterprises is different. To clarify, if the market share of the bid-winning products is now too high before entering the catalog, 60 to 70% of the sales volume of the bid-winning market can be changed. Changing price for quantity can quickly increase the sales volume of products and occupy most of the market share. However, if the market share is high before and the price reduction is large during the negotiation process, the amount exchanged at the price may not be enough to make up for the loss of the price, which will lead to the decline of enterprise profits. But even so, if we consider the aggravation of aging, the number of patients with chronic diseases is increasing, and the high drug price leads to the increasing medical burden of patients in the country. Medical insurance cost control is a very important means to reduce the overall burden by controlling drug prices. I believe the market has priced in the impacts, namely the era of high gross profit of generic drugs is over, and a reasonable profit margin of the manufacturing industry will be earned. In the future, we believe the reform will adjust the drug drug structure of medical insurance, by which I mean Medicare will make more space for covering patent innovative drugs. So it will benefit the industry in a long run.
Okay, so to summarize what you have just said, you are expecting the increased volume to make up for the deep price cuts that some of the healthcare companies are taking right now. Quite an expensive price to pay for being accepted by the Chinese government into their official drug list. But yet at the same time, even though China's long-term prospects in terms of the healthcare sector, it is attractive, but this is also a highly fragmented market. You're talking about 5,000 healthcare companies that are operating within this space, and top players in this healthcare sector, they actually hold a very small slice of the healthcare market. And this has created room for global healthcare companies like AstraZeneca and Novartis to go in to grab significant market shares from the domestic players. So Yen, my next question to you is, do you think China's domestic healthcare companies have what it takes to compete with these multinational healthcare companies?
Yes, I believe Chinese innovation will continue to break over the global pharmaceutical industry for decades to come. If you consider what's happened with COVID-19, within 8 months, China generated 6 original vaccines and 6 antibody candidates that entered clinical trials. Thanks to a decade of sustained government support, including policy reform, talent development, funding, etc., China's farm market is booming. We notice more and more private capital is available to the industry through venture capital and private PE, etc., which underwrite most R&D in China. Also, over the past years, China has enacted several policies explicitly to improve market access and support innovation. The Chinese government has also supported the development of science parks and city hubs for innovation and R&D by offering land to developers on a very attractive term. So I believe over the next 5 to 10 years, these homegrown companies will continue to improve their innovation capabilities and eventually compete directly with MNCs outside of China.
Thank you so much, Ian. And to also give credit to some of the Chinese companies over the past 10, 20 years, they have indeed been catching up to their global peers in several areas. Technology is one of them. And Ian, as you have just heard from him, he's also expecting Chinese healthcare companies to eventually catch up with the global peers. Okay, so thank you so much, Ian. Ladies and gentlemen, you have just heard from Ian, his investment case on why China's healthcare sector is one of the most interesting places to be in right now. So we will now shift our attention to a sector that is perhaps no stranger to all of us here, and that's actually the technology sector, which has been the poster child of the crackdown over the past year. If you have invested in any of the Chinese tech stocks, including Alibaba, Tencent, over the past 1 year, your losses would have been very steep. And if you just look at the Hang Seng Tech Index, from its peak last year, it is currently down by 60%. And such has been the extent of the crackdown on the tech sector in China. And we also have prominent investors declaring China tech stocks to be uninvestable. And that's a big call. That's a very big call. So the question that we seek to address today is China tech stocks a value trap at this point? Or is this a deep value opportunity that we should all take advantage of at this point? And to answer this question, I will invite Heather, who is our analyst for the digital economy, to present her investment case for China tech stocks. Heather, please.
Right. Thanks, everyone. Great to see everyone today. So yes, as many of you guys are aware, China tech has plummeted from highs as the regulations, delisting risks, macro concerns that has spilled over from the global economy and also the COVID lockdowns this year has all weighed on China tech this year. So here we plot some of the various key events that has happened across the past year, and just to highlight some of it, in March last year, 2021, we see that some of the several tech giants have been fined for price dumping by the Chinese regulators. And then in August last year, 2021, the regulators also imposed a time limit on gaming because they did not want the youth to be gaming too much. And then moving on to one of the major concerns, which some of you might have already read about, which is the delisting concerns. And these have heightened this year. And as you see on the chart, on 15 March, Hang Seng Tech actually plummeted to lows, and this was when the US SEC, Securities Exchange Commission, announced that 5 US listed Chinese companies are to be delisted by 2024. And since then, this list of 5 has gone up to roughly 80. So yeah, why did the Chinese companies actually face delisting? And the whole issue really surrounded on the fact that Chinese authorities did not allow the US listed Chinese companies to allow the US PCAOB, Public Company Accounting Oversight Board, to actually audit the Chinese companies' books. And also, this was the whole issue because the Chinese government did not want the data of Chinese consumers to be released to the US as they deemed it as confidential. But this was against US law because according to the US Holding Foreign Companies Accountability Act, all US listed companies, not only Chinese companies, had to let the US accounting board audit their books and also disclose government ownership. So markets were really concerned and really negative on this whole situation. But on 1st April, there's kind of a turn of events where the Chinese authorities actually announced draft rules in proposing a rule change. And what this rule change is basically allowing the US listed Chinese companies to let the US audit their books and also disclose government ownership. And so our view on this is that the risk of delisting significantly declines, and it really shows that China is willing to amend rules to prevent the US listed companies from being delisted. And also, this is really the first relatively concrete step by the Chinese regulators in allowing the Chinese companies to remain listed. And so this gives us confidence that the Chinese regulators intend to walk their talk of what they have been previously saying and announcing across the past year, where they have said they want to continue to support overseas listing, they want to stabilize financial markets. And also it shows us that the Chinese government is still heading towards the opening up of financial markets rather than heading backwards and closing up. And so, nevertheless, the risk is still not entirely off because although there have been progress made between the US and China, where the US PCAOB actually went to China just last week for further discussion and to reach an agreement, but it's not fully off until a full agreement is reached. And also, we see that a likely outcome of this whole situation would be that sensitive companies, which will be the minority of companies to be delisted, while the majority of companies that are considered non-sensitive to the Chinese government to remain listed in the US. So just one example is that last year, Didi was asked by the Chinese government to delist, and it was because they had confidential data of the consumer travel and all these. So, yeah. So all in all, that was on the regulatory front. And going forward, we also see that in the past year, the fundamentals of China tech has remained resilient. As you see on the chart on the left, revenue has continued to trend upward, and this demonstrates that demand is still strong and that services are still popular and growing and consumers are still continuing to use these platforms across the past year. And then when you look at the chart on the right, earnings has largely held up. It's still stronger than pre-COVID, which shows that digitalization has remained sticky. And although it is flat or a bit slight decline in growth from 2021, we think that it's rather resilient because we have to remember that last year, some of the companies had to pay fines and also some of them had to amend the regulations and work out how they would implement the regulations such as the minimum wage. And also we have to note that some companies still continue to deliver earnings growth such as Tencent and NetEase. So then moving forward, we still see that the long-term growth story of China's tech remains intact, and it will be mainly driven by digitalization. So here on the slide, we just have some of the few key drivers of the key internet segments, digital economy segments in China tech, and just to highlight some. So like looking at e-commerce, many of us know that e-commerce has grown significantly over the past few years, but there is still further room for growth and penetration. So just citing an example is that looking at the e-commerce grocery segment, penetration is quite low at 5%, while in the consumer electronics segment is higher, much higher at 40%. And so it just shows that e-commerce grocery is one of the segments that still has much room to grow. And this is an area where many of the e-commerce giants in China is trying to expand their footprint. Next, we also look at the cloud market, where in 2021, we saw strong attractive growth of 45% year-on-year growth. And going forward, the growth is expected to remain stable and strong at 25% CAGR. And also in the video game sector, over the past 5 years, revenue actually doubled. And now going forward, there's also still growth at 20% CAGR for the next 3 years. And also good news is that most recently, the video games license approval has restarted in April after having an 8 months pause as the regulation tightened. Another thing that we see also is a growth driver for the brands would be the international expansion, where the Chinese companies are expanding their global footprint. So just an example would be, for example, Lazada, who is owned by Alibaba. They saw a strong 52% year-on-year order volume growth in the last quarter last year, fourth quarter 2021. And so these are just some of the things that we see from the different segments of the internet sector. And now zooming out a little, we also see that the government's commitment to digitalization and growing its tech sector, and also the supportive macroeconomic backdrop as supportive growth drivers for the industry. So the government is committed to digitalization and innovation. And one example is that the government aims for the digital economy to account for 10% of total newly added economic output by 2025. And it shows how they're still seeing that the digital economy, platform economy is still important. And also, if some of you have read about it, the Digital Yuan project by China, it also shows that the government still wants to continue to facilitate digitalization and the shift towards technology. And so, as we see more digitalization, China tech stands to benefit. And then finally, on the macroeconomic front, China does stand attractive as currently inflation is not a major issue, and it gives the government more leeway to keep monetary policy accommodative. And we have seen recently this year some reserve ratio requirement cuts and also interest rate cuts. So in summary, with the long-term growth drivers of China tech and also of the industry, we think that China tech should see recovery as the regulatory overhang eases.
Thank you so much, Heather. Now time for some difficult questions for you. Just now, as I was talking about the steep decline in the shares of Alibaba and Tencent, I saw some investors here sitting with us nodding their heads. So I think some of us here have been caught up in the sharp sell-off in China tech stocks over the past year. And I think many of us here, each time there was a sell-off in China tech stocks, we think that we could go into the market to bottom fish, to pick up some cheaply priced Alibaba or Tencent stocks, only to be burnt time and again by the unexpected changes in the regulatory environment in China. So my first question to you, Heather, is it really different this time around?
Yes, indeed. So, great question. So yeah, first we all need to note that definitely the regulatory crackdown over the past year has been a major cause of the sell-off. But there have also been other factors, as I mentioned earlier, that like, for example, the COVID lockdowns, the delisting concerns, which is more of a US-China tension, and also the macroeconomic situation, and all these have also weighed on the sector. So what we have observed is that in 2021, a lot of the regulations have been concentrated then, and the Chinese government really just full force all of it in 2021. And since then, it has eased with less frequent, or at least not so much in this year. While in 2022, what really sent the stock market down are various things like the delisting concerns, macro concerns, and also the COVID lockdowns. So overall, we do see that it has rather relatively eased. And also, moreover, in the last two weeks ago, the CPC Central Committee, which is headed by President Xi in China, actually announced that it is necessary for the healthy development of the platform economy, and also they called for the complete rectification of the platform economy. And so all in all, it does seem like the worst is over for China tech. But what we really need as investors going forward to see are some positive catalysts which would really drive the recovery of China tech. So positive catalysts could come in the form of earnings growth, earnings surprises, and also we need to stop seeing negative news that can come in any forms. So yeah, more positive catalysts and less negative news. Yeah.
I think Heather brought up a very good point. I think if you look at the news headlines for this year, one of the common themes, one of the things that has been dominating news headlines this year is China coming out to say that they intend to do what they can to stabilize the economy. And that is the one thing that they have been doing. And also, I think what Heather has just mentioned, the ensuring the healthy development of internet consumer companies, that's also recently been highlighted in one of their government statements. So this year, it could really be different for China tech companies. Okay, we have talked about healthcare. We've also talked about the tech sector, but there is one distinct group of companies that is not just internet, but also healthcare. I'm referring to companies that are in the internet healthcare sector. So right now, I'll just shift the attention back to Ian. Ian, my question to you is on the topic of regulation. Chinese internet healthcare companies, they have been subjected to regulations over the past year. And that includes a ban on online consultations. And this is actually core to the business model of some of these companies that are operating in the internet healthcare sector. Companies like JD Health, companies like Alibaba Health. So my question to you, Ian, is how does this regulation affect these internet healthcare players?
I think these new rules represented the continued cautious stance of regulators on internet healthcare industry, as there are still many issues that haven't yet been adjusted under the existing practices and legal framework. For example, public hospitals are constrained by budget caps of the Healthcare Security Fund and are therefore reluctant to share budget with online channels. Indeed, the regulations has deepened concerns about restrictions on growth potential for the sector, but expected to push China's internet healthcare industry into the era of standardized development. To clarify, the policy has released a clear signal that online medical consultation should be the same of quality as that provided by physical institutions, which is essential for the standardized development and market expansion of the internet healthcare industry. We know China has 1.4 billion people. They have a huge demand for healthcare services, and physical hospitals are definitely able to meet this demand. With the regulatory policies for the internet healthcare becoming more transparent and standardized, companies providing actual medical services with a sound regulatory compliance system like Alibaba Health and JD Health are expected to benefit in a long term.
So in short, short-term pain from the regulations for long-term potential gains. And judging by the share prices of some of these consumer healthcare internet companies, a lot of pain has been reflected in their share prices. And also, back to Heather, on the topic of business models. So we all know right now that Alibaba and Tencent, they have actually been asked to open up their walled gardens, their ecosystems to their competitors. And this walled garden, this ecosystem has traditionally been a source of competitive advantage for some of these big tech Chinese companies. So my next question to you is, Do you think that the government's regulations, the government's intervention into these Chinese big tech companies has permanently affected the long-term business models of these big tech companies?
Right. So the short answer is no. The business models are still intact and still sustainable and not damaged totally. So first, we all as investors need to note that even with the regulations, these Chinese companies, that they still play a key and important role in the Chinese economy, where their services and goods are still very necessary for the daily consumer. So with that, just an example, it will be Meituan. Even though they had to pay some benefits to the delivery riders and also to the merchants, overall, you can see that their algorithm and cost optimization in their business model has given them a competitive edge. And so if with that, their services are still there and you still have demand. And so overall, the business models are still intact. And second, we also need to note that the government's intention is not to hinder the growth of these Chinese tech giants, but rather they want to create a fairer competitive landscape. And this in turn will drive more innovation in the industry as there is a fairer competition. And so overall, we see that these tech giants have also gone along this line of innovation and this trend, and they have found new ways to grow earnings. So for example, Baidu has recently launched their autonomous driverless taxi fleet, which is the first autonomous taxi fleet in China. And so this is something very innovative. And also in Alibaba, their cloud computing business has also shown a strong growth, and they have been expanding into new verticals, and also Tencent's fintech business. So overall, we just see that these companies have continued to innovate, and this is also aligned with what the government wants. So all in all, with the businesses still being very necessary to daily consumer, and also seeing that they continue to find ways to innovate and grow earnings, we do think that the business models are still intact and still will grow.
Thank you so much, Heather. So, ladies and gentlemen, Heather has just presented her investment case on China's tech sector. So if you have been holding on to shares of Alibaba, Tencent, or even the Hang Seng Tech ETF, perhaps now is not the best time to sell it, because you're probably selling at the bottom right now. And for those of you who still believe in the future of China tech stocks, Heather thinks that now is perhaps the best time to go into the sector. Okay, right now, we will shift our attention to another sector that has also been experiencing a lot of distress because of the crackdowns by the Chinese government. And that sector is the real estate sector. And this sector has been undergoing a lot of distress because of the government's crackdown on excessive leverage. And we have already seen quite a lot of defaults among Chinese property developers over the past few months. So the question that we want to address today is, have we already seen the worst of the debt crisis in China? Or is there still more pain to come? So to answer this question, I will now be getting Hui Shi, who is helping to cover the real estate sector, to share with us her views on China's real estate sector. So Hui Shi, please.
Thanks, Weiren. Yes, so the property sector, it was also another area where China had launched a crackdown on. And needless to say, Chinese property bonds, they have gone through very rough times after the crackdown. We have Evergrande, which was the first major developer to fall to the tightened regulations, and its downfall had also sent a rippling effect across the rest of the property sector. And we see the carnage continuing on this year, with more developers missing their coupon payments, and also the Russia-Ukraine crisis has also added on to the market uncertainty. But despite this, we think that the worst could already be over for China's property sector, and we see that the sector is set for better times ahead, and that also provides investors with an opportunity. And here are some of the reasons why investors should start considering investing in the Chinese property bond market. So with this year being a politically important one for China because of the 20th Party Congress, we think that the property sector will be one of the key areas of focus, especially since its downturn had cast a shadow on China's economy. And with respect to this, we have the Vice Premier Liu He, who is President Xi's closest economic advisor. He has said that the government needs to reduce the risk in the property sector, as well as propose measures to facilitate a new development model. And so what we could possibly imply from this statement is that China's property sector has likely already reached a turning point. At the same time, we have heard from the regulators who have once again, they have reiterated their intentions of stabilizing the property market, and we have the Finance Ministry announcing that a property tax trial that is initially planned for this year will be put on hold. So overall, we think that China's assurance of providing continued support to the property sector, that should paint a better picture for the outlook of the Chinese property bond market. And at the same time, this policy easing environment, that should be a key near-term catalyst for the recovery of the sector. And currently looking at the prices of the Chinese property bonds, we see that most of them, they are still trading at distressed levels despite some recovery from their March lows. And in fact, more than 50% of those bonds, they are currently trading below 50 cents on the dollar. So half their values are being wiped off. And this is a significant difference as compared to the end of last year, where only about 15% of such bonds were trading at such distressed levels. And we also keep in mind that the ongoing policy easing environment, that should help to alleviate some of the credit stress that's being faced by the developers, and that should also help to keep default rates in the sector from reaching extreme levels. So we do expect the default rates in the sector to remain manageable. And more importantly, I think that current bond prices, they already seem to be pricing in a large degree of credit stress. And therefore, we believe that the sector is offering investors with attractive risk-adjusted returns, and current bond prices are presenting investors with an attractive entry point. And besides looking at the bond prices, we can also consider the spread levels of the Chinese property bonds. And currently, their spread levels have widened to over 2,900 basis points, and that is about 29%. And this is still one of the highest levels on record, despite some recovery from their March highs. And relative to the US and Europe high-yield bonds, we also find that the Chinese property bonds, they offer a spread differential of more than 2,000 basis points, which is more than 20%. And I think this highlights the fact that Chinese property bonds are providing an attractive yield pickup over their global peers. And also, the bonds, they provide a combination of not only higher yields, but also shorter durations. The bonds, they currently have a yield to worst of over 30%, and that is several times higher than that of the US and Europe high-yield bonds. This also comes alongside a relatively shorter duration of less than 3 years. And as a result, we find that Chinese property bonds, they have the highest yield per unit of duration. Also known as the Sherman ratio, this yield per unit of duration, it is a measure of interest rate risk. So what this means is that a ratio of 1 would indicate that it will take a 1% rise in interest rates in order to completely offset the yield of a bond. And hence, having a higher yield per unit of duration, this can potentially provide more buffer to offset the impact of rising interest rates. And this also makes Chinese property bonds with their highest yield per unit of duration a more compelling fixed income investment option against the current backdrop of aggressive rate hikes, which are obviously going to have a greater impact on global peers instead. And for investors who want to ride on the recovery of the Chinese property bond sector, we recommend this ETF, which is the Premier China Property Bond ETF, which is listed on the Hong Kong Exchange under the ticker 9001. Currently, only ETFs are able to provide investors with a dedicated exposure to the Chinese property bond market. And specifically, this ETF, it is the only product available that is able to provide such diversified exposure. This ETF, it invests in secured as well as senior unsecured rated offshore USD debt securities that is being issued by the property developers as well as the REITs. And with these securities being largely secured, they can provide investors like us with better recovery prospects in the event of a default. And this actually differs from your typical Asian high-yield bond funds or Asian high-yield bond ETFs, where securities being held, they can either be senior or subordinated. They are typically unsecured, and sometimes they may even be unrated. And other key details of this ETF is that it has an average credit rating of BB, and that is the highest out of the speculative grade. And also it counts the more resilient developers like China Vanke as well as Country Garden among its top 10 issuers. And so overall, to sum up what I've just mentioned over the last couple of slides, I think the risk of defaults in China's property sector has largely already been priced in. And also considering the policy easing environment, we think that the property sector is set for better times ahead, and the worst is likely already behind us. And as such, I think the risk reward of the sector is now being skewed to the upside, providing investors with an attractive entry point. And of course, investors can stay diversified through instruments such as an ETF in order to gain a diversified exposure to the different property developers, as well as to minimize any idiosyncratic risk.
Okay, thank you so much, Hui Shi. Well, I think we can all agree that the Chinese government has been very forthcoming in terms of its support and policy measures to help support China's real estate sector. But the reality on the ground is that home prices and house demand, they have actually been falling over the month, which means that it is still not taking effect. These policy support measures, they have not taken effect on the property market yet. Housing prices have been falling, demand has also been falling as well. And these two factors, they actually reinforce one another, because if I expect home prices to fall further, then I will of course want to delay my purchase. And when everyone delays their purchase, and that also causes home prices to fall further. So given these factors, given what is actually happening on the ground right now, so my first question to you, Hui Shi, is it still safe to assume that the Chinese government has everything under control?
Thanks, Ryan, for the question. I think this is a very good question. So firstly, there are some risk factors that I would like to address and acknowledge. So firstly, the policy easing from the government, it could be too little or even too late. So far, efforts undertaken by the government to stabilize the property sector has been fractional, and so far it has also produced little positive impact. And so if additional policy easing from the government comes too late, or takes too long to be implemented, that could also be possibly too late to restore the confidence in China's property sector. And besides this, I think another risk factor will be COVID-19 lockdowns. Given China's very strict COVID-19 policy, having more COVID-19 cases in even more cities could also result in further lockdowns in China. And that could hurt the developers' contracted sales and also delay the recovery of China's property sector. But despite this, I think we also have to acknowledge that the property sector is an important component of China's economy. The sector contributes about 25% of China's GDP. So I think China is unlikely to let the property sector to fail, as that would have detrimental impacts on the rest of the economy. And also, despite the sector having its own challenges, I think that there's still value to be found within the property sector. I think that there will certainly be some developers who will be able to withstand a prolonged downturn, assuming that the recovery is slower than expected. Because the reality is that not all developers are created equal. Not all developers are like Evergrande or Shimao Group. There will certainly be some developers who have much stronger fundamentals given their better liquidity positions. And such developers will include some of your SOE companies. So I think this kind of companies are likely to survive through this crisis. And so my advice for investors right now will be to stay diversified through instruments such as an ETF in order to minimize any idiosyncratic risk.
Thank you so much, Hui Shi. And right now, I'd just like to shift the attention, the focus of the discussion to the banking sector, which is represented by Feline. She hasn't presented her investment case for Chinese banks just yet, but we cannot talk about the property sector without highlighting the banking sector, because these two are interlinked given the importance of the property market to China's economy, and also the fact that there is a lot of lending by Chinese banks to these property developers. So my question to you, Feline, is from a banking perspective, do you think that the wave of defaults that we are seeing in the Chinese property market right now, is that going to create significant stress on China's banking sector?
Okay, yeah. So just like you mentioned that the banking sector has quite a significant exposure to property-related sectors. So that's true. So on average, Chinese banks have about 30 to 40% exposure to property-related sector. But I think it's very important for us to know the rough breakdown, which is that majority of these loans are actually in the form of mortgage loans. And when I say majority, I meant about 30 to slightly over 30% are in the form of mortgage loans, whereas the remaining 6 to 8% are then to loans to property developers. So when it comes to mortgage loans, there are probably less concerns over it, given how buyers in China, they have to fork out huge amounts of money to pay for their initial deposits, which kind of reduces the risk faced by the banks. And for the property developer-related loans, so I think it's also worth sharing that most of these loans are already collateralized, which helps to cushion any further defaults, if any, in the property sector. And also, according to Bloomberg, on average, 70% of these loans to property developers are secured with collaterals, guarantees, and pledges. So in some way, I think that the direct impact on the bank's assets, the loan book, may not be as bad and may not be as significant as what many people are thinking. So in my opinion, I at this juncture, I don't think that there will be significant stress on the banking sector.
And the fact that the Chinese government has been willing to allow China Evergrande to default on its debt without needing a bailout, I think that itself also shows that the Chinese government, they probably have some confidence in the ability of the banking sector to absorb stress at this point in time. Okay. No, back to Hui Shi. I think one of the main concerns that investors have towards these Chinese property developers is the use of hidden debt in their balance sheets, the use of financial engineering to hide the true amount of obligations that they actually have on their balance sheet. And even the credit rating agencies, they have been caught off guard because some property developers, they were initially judged to have enough cash to repay their bonds, only to find out that they actually don't have enough to repay their obligations, and they ended up defaulting on their bonds. So my next question to Hui Shi is that what is your assessment of this situation of hidden debt right now? And are we expecting to see more defaults ahead, more unexpected defaults ahead?
Yeah, this off-balance sheet financing situation, this is very real, and so far it has already damaged the market confidence in China's property developers on the whole. And I think the recent auditing crisis, where some developers, they were unable to report their audited results before the deadline, it has once again shed light on the excessive use of off-balance sheet financing by the developers. And so far, I think what we can learn from this situation about this auditing crisis is that developers who have managed to release their audited results before the deadline and auditors did not report any material uncertainty regarding to going concern, I think these kinds of developers would have much lower credit risk. And examples will include China Vanke, Country Garden, as well as Sifi Holdings. But also at the same time, we have developers who did not manage to report their audited results before the deadline, and auditors also had reported material uncertainty. So for these kinds of developers, I think that there's a high possibility of them having excessive off-balance sheet financing. And of course, I think that would affect their default risk, so they have higher risk of defaulting. And prime examples will include not only China Evergrande, but also Shimao Group, and also Sanex China, who recently just missed one of their coupon payments. And so considering this, I would not rule out another wave of defaults in the property sector. But then again, we have to keep in mind that markets, they are forward-looking, and I think that a large degree of default risk has already been priced in by the market. So if you take a look at developers who have so far have issues with reporting their audited results, we can see that their bonds are already trading at distressed levels. In fact, for Sanex China, even before they miss one of their coupon payments, all of its bonds are already trading below 30 cents on the dollar. And with most of the potential downside being priced in the Chinese property bond market, I think that the risk reward of the sector is now skewed to the upside. And I think that provides long-term investors with an attractive entry point right now.
So in a nutshell, a distinct differentiation has to be made between the good ones and the bad ones inside the property market. And also diversification is important for a distressed sector like China's property market. Okay, so thank you so much, Hui Shi. And ladies and gentlemen, you have just heard the investment case for China's property sector. And right now, we'll just move on very quickly to our last sector for the day, and that's the banking sector, which is represented by Feline. And the Chinese banking sector has surprisingly been holding up well despite the volatility that we have seen in China's equity market. So right now, I'll just invite Feline to present her investment case for an investment into China's banking sector. Feline, please.
All right. Okay. Thanks, Weiren. So yeah, as the last speaker for this session, I just want to share one of the most important sectors in any economy, which is the China banks. So in our opinion, there are three big reasons why we think that you should pay attention to the Chinese banks. So number one, we believe that there's still very decent growth prospects for the banks. Number two, they are very, very attractive yield plays. And number three, they are trading at very cheap valuations level. So just to start off with, my first point is about the growth prospects of the Chinese banks. Yeah. Okay. So when I'm talking about growth prospects, specifically, I'm talking about the net interest income outlook of the banks. So the reason why I want to focus on this is because for the Chinese banks, majority of their operating income actually comes from net interest income. So about 80% on average. And so naturally, I think it's important for us to take a deeper look at this revenue stream. So when it comes to net interest income, there are two components. We have the net interest margins and we have the loan growth. So just now, I think we have discussed quite in depth about how the Chinese economy is currently facing a softening economic growth. And to tackle this, Chinese regulators have implemented several easing measures to stabilize the economy. So rate cuts is one of them. So as a result, we do expect to see the net interest margins of the banks narrow in the coming quarters. But on top of rate cuts, there are also other easing measures. We have the reserve requirement ratio cuts. So this was done in December last year and April this year. And what this means for the bank is that they do not have to hold as much cash with the central banks as before, which should translate to higher liquidity available for lending. So in fact, in January this year, we saw a record amount of new loans being extended by the Chinese banks, during which it grew by 11%, and most of these growth came from corporate loans. But what was really interesting to see is that the year-on-year growth in mid to long-term corporate loans returned back to the positive territory after a contraction that lasted throughout the second half of last year. So of course, moving forward, we remain cautious over the short-term outlook of the new loans given all the lockdowns in the major China cities. But generally, we are still optimistic about the overall loan growth of the bank in the coming years, given how we are seeing increasing capex in key sectors such as manufacturing and industrial. So in the 14th five-year plan, Chinese government, it said that it aims to become a manufacturing powerhouse by upgrading their current industrial and supply chain in the next couple of years. So one good example is the semiconductor industry. So the Chinese government has been stepping up its effort to promote the local semiconductor industry because they want to aim to achieve self-sufficiency when it comes to chip production. So all this capex and upgrades, in our opinion, should translate to loan growth for the Chinese banks. And in fact, we see that corporate loan growth will be the main driver behind this loan growth for the banks. And besides, another point take note is that while China may be facing a softening economic growth, I think it's imperative for all of us to know that it is still one of the fastest growing economies in the world. So looking ahead, we can still expect to see double-digit loan growth in the financial year of 2022, which in our opinion will be a key factor that should help to support the bank's net interest income despite pressured net interest margins. And moving on to the second point, dividends. So capital return programs, which includes dividend payouts, they have been a very important component when it comes to any bank investors. So this is the same for the Chinese banks as well. So as you can see on the chart on the left, you can see the stark difference between the bank's price return and total returns, which include dividends. So I think investors will also be very happy to know that the Chinese Big Four banks, they have been increasing their dividends per share consistently over the last couple of years while maintaining a payout ratio of only 30%. So going forward, coupled with rising profits, we are inclined to believe that these dividends paid by the Chinese Big Four banks are indeed sustainable. And also at current share prices, investors can expect to receive dividend yields of more than 7% on average in the next couple of years. And finally, moving on to our last point, which is valuations. So you can see on the chart again, Chinese Big Four banks are really trading at very, very cheap valuations level. And at this kind of valuations level, we really do see more upside potential than downside risk for the banks. And besides, just now, we also mentioned, so the Big Four banks are actually now on a much stronger footing today. They are very well capitalized. They have adequate buffers to better prepare them for potential challenges ahead. So just to bring back my previous point again on dividend yield, if you are to enter into Chinese banking industry, you're actually getting paid at 7% every year while you wait for share prices to rebate. So therefore, I think to really sum it up, I think that the Chinese Big Four banks could be a very interesting industry for investors to consider, for those who have the risk tolerance, or also for those who've with the patience to wait for share prices to rebate. So our recommended product for this is none other than the China AMC Hong Kong Banks ETF. And for this ETF, it is listed in Hong Kong Exchange with the ticker code 3143. And also, Big Four banks actually makes up almost 50% or more of the total net assets of this index.
7+% dividend yield, that's actually quite attractive. For comparison, Singapore banks dividend yield right now on average you're probably looking at about 4+%. So 7% is indeed a step up in terms of the yield. So in the interest of time, I'll just have one question for you, Feline, on the opening up of the banking sector in China to foreign players. This is indeed an attractive market, but yet at the same time, China is also allowing foreign players to come into its market. And that also means that in the future, in the long run, there's going to be increased competition in the banking sector. So Feline, what do you make of this situation?
Yeah, okay. So when China opens up its financial sector, no doubt competition will rise, but not everything is bad. So for example, right now, investment banking and security services are actually off limits to the China, even the largest China commercial banks, because the Chinese government, they want to minimize the risk faced across different aspects of the financial system. But now that they are opening up the financial sector, the Chinese government realized the need to kind of support the domestic players against the fight with the larger foreign players. So there were actually reports stating that the Chinese government is looking to break down the walls between the investment banks and commercial banks. So they are looking to issue new licenses so that the commercial banks can start offering investment banking and security services. So what this really means for the Chinese banks today is that this could be a potential new revenue stream in a form of fee income for them, which could then serve as a potential re-rating catalyst in the longer term. But besides that, I think more importantly, opening up of the financial sector really promotes transparency across the Chinese banks, which will also allow them to be more integrated to the global economy. So in our opinion, when that happens, this should reduce the risk premium that current investors are assigning to the Chinese banks, which will once again in the longer term help to support the overall valuations of the Chinese banks.
So more competition ahead, but yet at the same time, the Chinese government is going to support their domestic players and equip them with the necessary means to compete with some of these large players globally. So thank you so much, Feline. And ladies and gentlemen, you have just heard from Feline present her case on why you should consider an investment in the Chinese banking sector. So this is our final sector for the day. And just to wrap up today's segment, I will get each of the analysts to just conclude in a few sentences their investment case for their respective sectors. So I'll first start with Yen.
Hi. I think healthcare sector is the best place to be in right now because it has solid fundamentals. We know China has huge potential for patient and economic impacts. Its innovation is faster growing. Eventually would compete directly with MNCs outside of China. The current valuation of the sector is also attractive, so I believe it would generate attractive returns for investors.
Thank you so much, Yen. Yen represents China's healthcare sector. How about you, Heather?
So yes, China is one of the most innovative and digitalized countries in the world, and going forward, they aim to be even better and to be one of the leaders or even the leader. And so going forward, definitely China tech is going to grow, and long term, we still think that it's really attractive.
Heather represents China tech. And what about you, Huishi?
I think China's property bond market is the best place to be in right now because most of the downside risk has already been priced in after the significant drawdown that has happened over the past 1 year or so. And with the Chinese government pledging support to the sector, I think that the worst is already behind us and the property market is set for better times ahead. And at a yield to worst of over 30%, I think Chinese property bonds are looking very attractive, especially for long-term as well as income-seeking investors.
The only analyst today to be talking about bonds instead of equity. So could be something interesting for you to consider. So Huishi represents China property bonds. And what about you, Feline?
Okay, so I believe that Chinese banks is the best place to be in today because not only is it offering very attractive capital gains, but again, you're getting paid 7% per annum while you wait for share prices to re-rate. So right now, regulatory landscape in China is likely to remain fluid given how China is still undergoing rapid economic development. But trading at only 0.4 times, we really believe that there's more upside potential than downside risk for the China banks today.
Thank you so much, Feline, and thank you also to all the 4 analysts today for sharing your views with members of the audience. So I hope this session has been useful to all of you, those who are physically here, as well as those of you who are joining us online via the live stream. So I think China, obviously, there is a lot of things to worry about. But yet at the same time, it is also fair to say that a lot of this negative overhang has been reflected in the share prices. And as our analysts have highlighted today, there are still opportunities within China's equity market. So with that, I'll just conclude today's China's debate session. Thank you so much once again for joining us here at our ETFestival.